talking $700-800 payments for a vehicle, hot tub payments, like motorcycle payments. Let's not worry about our mortgage going up by $100 here and $100 there. Like, our mortgage is actually an asset. It's a phenomenal investment. Let's get rid of the other stuff that are these huge payments.
They did it. They raised the rates, just like they told us that they were going to do, just like we knew all along. But it was only a matter of time until this actually happened. There shouldn't be any fear in the market. And if you listen all the way to the end, we got fired up on this episode towards the end there, and I think you're going to love the feedback. There's worse things to worry about in this world. But that being said, there is a concern because this is your money and your budget and your livelihood, and it's important to understand specifically how raising interest rates impact you. So if you want to learn who this impacts, what happened, how it happened, what could happen next, some forecasts, what to look out for, should you lock in, and or what else to consider in your budget, you need to be listening to this episode. I'm Alex McFadden. My business partners Dean Lawton and Derek Williamson are also by my side to present to you a breakdown on what the Bank of Canada did. Are they going to bankrupt you, and should you lock in? We're the owners and partners here at Thrive Mortgage Co., proudly the #1 mortgage financing small team in Canada last year. I don't even know if I should say small team. We're so thankful that you guys listen to us here when you're looking for lending and real estate advice and investing. And we'd love if you would either A, subscribe, B, check us out on YouTube and subscribe, C, find us on Instagram at Thrive Mortgage Co. And of course, if you're loving the episode, tell somebody about us, because we'd love to help more families just like you. Guys, this is going to be a fire episode, so I'll leave it there. Enjoy. What's up, guys? You are listening to the YVR REMO show, where we talk all things Vancouver real estate and mortgages, take boring topics and make them interesting. Make sure to stay tuned to listen to everything you need to know how to put cash back in your pocket, create wealth in real estate, and simplify the complicated. So it actually happened. The Bank of Canada decided to take the plunge later than expected, because it was originally anticipated that in January of 2022 was when we were going to see the first of what's considered to be multiple rate increases to the bank's overnight lending rate. Of course, we were talking about what impacts those consumers in the real estate space as variable rate mortgages and lines of credit. To be more specific, what happens is the bank meets multiple times throughout the year, and they have control of what they call the overnight lending rate. And the overnight lending rate changed on March 2nd, 2022, which is why we're having this conversation. We're going to rewind. We'll go back and explain exactly what you need to know around what happened, who it affects, what are the numbers, what you need to do, should we be concerned, are we going to lose our houses, and a lot more. So we're going to get into it. Let's talk about it, guys. What the heck just happened?
Right off the bat, I just want to mention that a lot of these headlines reference 0.5%. That is where the overnight lending rate went to. It was initially at 0.25%. It was a 0.25% increase, and it's now sitting at 0.5%. It was not a 0.5% increase, and that I probably got 15 questions on that within 2 hours. Everyone assuming that it was a bigger jump than expected. So it was in fact only 0.25%.
I think it's a good point. That does cause a lot of confusion, to your point there, but also that is the overnight lending rate from the government to the banks, right? That's not the prime rate, but that is exactly what will impact the prime rate. So until today, we're recording on the 3rd of March, I just saw the first banks, RBC and TD, actually decide to match that increase to their prime. And so now it's important to understand the difference of the overnight lending rate versus prime rate, right? And that's primarily where we saw a lot of confusion. Is to Derek's point, we're seeing 0.5% is what the new overnight lending rate is, and we're getting a ton of calls of realtors and clients thinking that their interest rate's going up by a 0.5 point, meaning prime, right? So prime is now going to be, what is it going to be? 2.7% will be the new prime rate for most banks, everyone other than TD. And I don't think we need to get into too deep of a talk of why TD is a little bit different, but I think it's just important to delineate the difference there of the overnight lending rate to prime.
No question. Absolutely no question. So specifically, how this impacts you as a borrower, to Derek's point, is that when the interest rate went up by 0.25%, that's a 0.25%, then what generally is going to happen, and we've seen this happen, is the bank's prime rate, as Dean indicated, whether it was 2.45 or 2.6 before, is going to go up by 0.25% to match the policy rate. Now, it's interesting to note, a lot of people don't realize this, that the banks do not have to exactly follow the policy rate, nor do they always do so. Perfect example would be TD is at 2.6, and most of the rest of the banks, in fact, every other chartered bank along with most mortgage lenders, are at 2.45. A few years ago, when we saw interest rates go down, the banks opted not to go down the full 0.25%. At the time, they only went down by 0.10 or 0.1 or 0.15, but they're going the whole way back up. So we go up the elevator and down the stairs usually, which is interesting. So not much really, though, in terms of the big impact. It's not the big scary rate hike that the news was talking about. We'll talk a little bit more about what the bigger version or the bigger picture could look like over the next year or 2 or 3 years as we get through this. But I mean, let's just talk frankly about who this affects, guys. Like who is this actually impacting and how?
In the mortgage world, it's variable rate mortgages and home equity lines of credit. Like those two products fluctuate with prime. So I'll give you an example. If you are at a prime -1, meaning like 1% is your discount off of prime, that's how a variable product works. You're either at a discount or a premium on top of prime. So now that prime's gone from 2.45 to 2.7, your rate would have went from 1.45 to 1.7, right? So rates across the board, variable mortgages and lines of credit are increasing. Does this impact your payment? Most lenders, yes. There are a handful of lenders that offer a static payment, or you can think of it as a fixed rate payment in a variable product, meaning that even though rates have gone up and maybe your payment should jump by $60 or $70, your payments actually stayed the exact same. Inside of that payment, you're paying a bit of extra interest and a little bit less principal. So make sure that you understand the mortgage that you're in if you're in a variable, because you might not see any change in your mortgage payment, or you may see a change and you just want to prepare for that.
Who does this affect would be anyone in a private lending mortgage. A lot of private lenders will market their rates as prime plus. So you're paying your prime interest rate plus whatever their we call it a discount for most variable rate customers, but it's a surplus in that case. So those people are going to be impacted. We see a lot of construction mortgages. So anyone that's carrying a construction loan typically are on a prime plus type of a situation as well. And then any unsecured products, a lot of unsecured line of credits are also prime plus. So if you have an unsecured line of credit, you're also going to be looking at an impact there. I'd say those are probably pretty well covers it all.
Yeah, and I mean, we touched on this in multiple episodes and glossed over this, but let's break it down, obviously, into numbers, and I'll get back to who it affects in more detail as well. $12 is the magic number, guys. $12 per 100,000 borrowed. If you have a mortgage, a variable rate mortgage where the payments change, which is with many of the lenders, for example, if you're with Scotiabank, your payments will fluctuate along with the rate, which is good if you want to pay off your loan based on your amortization period. Whereas if you're with a bank like a TD or maybe CIBC, you have a locked-in variable rate, which means you just pay more to interest or less principal. But it's $12 for every 100 grand. So for the average Canadian mortgage holder at a loan of around 400,000, we'll say 500 for today's sake in Vancouver and the Lower Mainland. That's $60 on your monthly payment that you would see the difference, right? Equivalent to a cups of Starbucks a week in coffee reference, and maybe quite literally going out for a few beers with your friends. So not a massive impact, although in the grand scheme of things, it's something to consider. One other point to note, and we talked about who does this affect. Dean and Derek did a good job of breaking down mortgages with a variable payment and, of course, private lenders. But we cannot forget all of those folks underneath that window who have variable rates and have investment properties who are looking and calculating their numbers. Does this mean you should not invest? Oh, heck no. This definitely means you should continue pushing forward. But you should probably look at your numbers just to recalculate them accordingly.
I think one of the most important pieces to touch on is who does this not affect? If you're pre-qualified, meaning you're pre-approved for a purchase, This does not impact your qualification whatsoever under no circumstances. This is nothing to do with the qualifying rate. This is just the final rate that you'll pay. So I've had that question come up a lot. Oh my gosh, is this going to change my pre-approval? No, not at all. No impact.
Well, let's stop on that for a second. Let's break this down. I mean, if you have a pre-approval or a qualification in place, let's break down what does that mean? How are you qualified and why doesn't that impact it? In Canada, we have something called a stress test. A stress test came for all mortgages in 2017-18 and was recently updated and changed in 2021. The stress test currently sits at 5.25% or 2% above the rate that you have. So for most Canadian consumers, because they have the option to take a variable rate right now, and let's say the discount is 1 off of prime, they'd have a rate of 1.7%. So because you can qualify you at that, we qualified you already using this 5.25% payment. Now, if we saw interest rates go up a couple of percent and or fixed rates continue to rise, the Bank of Canada does have the ability to adjust the stress test rate, although at this time there are no indications that they will still do so, while fixed rates still hover in the high 2s and low 3s and variable rates are in the 1s and 2s. So you're good, no problem, and thanks for clarifying that.
Just back to the rates themselves, there's all this talk and fear about rates rising. And yes, rates did go up as they were expected to. If you were in a variable hoping that rates weren't going to go up and they were, you're going to keep your 1.5% forever, that's not realistic. But on the flip side to this, nobody seems to understand the fact that fixed rates have already been rising for the last 12 months. And we have lenders offering 5-year fixed rate mortgages at 3.39%. That's becoming common. Right. And that's been happening for 12 months, but that's not in the media. It's not in the news. People don't think about that. So now again, like we touched on earlier, this is only impacting variable and home equity line of credit borrowers. But I mean, you need to consider that, if a variable that was at 1.5% is now at 1.75, compare that to the fix that's being offered today at 3.39 in some cases, right? We are still dramatically below the fixed rate if you were to consider locking in. And I think we should touch on that quickly because that's the first thing that comes to people's mind when they woke up 2 days ago and rates went up. Should I lock in, right? We got that question probably 150 times in 8 hours. And a lot of those situations, the answer was no, right? There are situations where it could make sense to lock in 100%. You need to know your situation. But for most people, given where rates are at and given the spread between the two, we could weather another 1.5% of increases, and even then we're probably just breaking even with the fixed rates being offered today, right? This could be a totally different conversation if fixed rates are at 2.4, right? That's a different conversation, no question, but fixed rates are so much higher right now, it's very tough to commit and jump into something like that. And you think about all the reasons where the fear comes from. It's well, my payment's going to rise. Yeah, but your payment's going to jump dramatically if you go fixed, right? And you're committing to that, and you're putting yourself in a product that can be, very restrictive with big penalties. So I'll let one of you guys take that away a little bit further.
Well, I mean, just on the fixed rates, you could almost I had a client say this to me the other day. They're are the banks preying on the fear of variable rate customers locking in, and that's why they're so high? I mean, I'm not in a conspiracy. I'm not going to get into conspiracy things here, but at the end of the day, they are at an all-time high when you look back at the last, say, 3 years. The fixed rates are at the peak in the 3-year mark, and they're above where they were pre-pandemic levels. So, to your point, they are winning on this idea of variable rate customers or just anyone in general locking in from a point of fear. The banks are benefiting from that. We talked about this on our last episode that we're going to see record profit years for the banks this year and likely next year for this reason alone. A ton of people are going to lock in for this reason. But I've always looked at this. Even if variable rate was the exact same as a fixed rate, my personal situation, my goals, where I want to be from a flexibility standpoint and moving forward with my goals from growing my portfolio, I would take the variable rate just for the flexibility if they're the same exact rate today. And so that's me making a decision because of flexibility, penalty issues, wanting to have the freedom to refi when I need to, wanting to have the ability to sell at my own terms. So these are things that I would ultimately pay a premium for. I would argue even if you gave me the choice and the variable was higher, I'd probably still go variable. So everyone has their reasons. I mean, there's so many different situations where I would totally recommend a fixed rate mortgage for somebody. Fixed budget, downsizing, senior, first time home buyer just squeaked in the market. Like, you have to know your numbers. Like, you really need to know your numbers, especially when it comes to an investment property and you're trying to cash flow and make sure, like, if you're in a fixed budget and this is your first investment property and this property's in your in your portfolio or in your plans for the long term, fixed rate might be okay for you because you just need to make sure your budget doesn't change. And so, like, everyone has their reasons. I think it's really important to just know your why.
I'll riff on that a little bit more. Dean's not providing blanket advice to anybody to say, hey, if you're a first-time buyer, go fixed, or if you're an investor, go fixed. The suggestion here is quite simply just to let you know that it's not an evil in that perspective, but it's something to be hyper aware of. I think something that people don't realize, on that point, and we talk about this, but it seems to go glossy-eyed, is there such thing as a 2-year fixed term or a 3-year fixed term? And because, like, I don't know, man, like, today I think we had 5 or 6 consultations. When I say we, I mean myself, here, 5 or 6 consultation calls. Every single one of those people was breaking their mortgage term, and the penalty ranged from 3 months worth of interest to, in one case, $47,000 on a $600,000 loan. And so it does have a dramatic impact. So to your point, Dean, I do agree. You definitely have to look at your personal situation and budget, which is where also Derek brought this up. Frozen payments can come in really handy. But at the end of the day, if you can't sleep at night, then go for it. Pay the higher amount, go fixed. But remember, you can do shorter terms. 2 years, 3 years. Funny enough, like, when I got first into lending, it was very common for people to go 2 year to 2 year to 2 year to 2 year. It only became more common to go 5 years as kind of the mid-teens went on and banks kept pushing it and advertising it and so forth, right? So it only became the norm in the last 8 to 10 years here.
Yeah, I mean, we've said this probably 50 times on this podcast, but the stat is that the average Canadian breaks their mortgage every 3 years. Like, why do people take a 5-year fix then, right? I fall into that stat. And it's not all about selling your house. It's refinancing. It appreciated. You want to pull some money out, pay off debt, renovate, whatever. There's just so many situations that come up where you're breaking your mortgage, and you're bang on with the shorter terms, right? And another part of this too is certain lenders have calculations that are going to create a larger penalty than others, right? Like, typically the big banks, like, we love the banks, we need them to operate, we do a lot of business with them, but their fixed rate products are typically going to have a higher penalty than some of the other mortgage lending companies out there that we work with, right? So that's a big part of the planning and strategy that we dig into, is like, if you're going to go fixed, let's pick the right term. You're never going to pick the right term because you don't know how long you're going to live in a house, but we can guess and assume and hope for the best and try not to overestimate. And number 2, try to place yourself with the right lender. That's the best thing you can do for yourself if you're going to go fixed.
Yeah, that's a good point. So, I mean, in summary of all of what we're suggesting here, none of us are actually suggesting, I know there's a lot to go on there. We're actually not suggesting you to go fixed, at least not as of today. We won't tell you what to do in any case scenario. We are still all holding pretty steady on the long-term value of the variable. If you're concerned about payments going up, either go to a frozen payment, switch lenders if you have to, or if you have the option, which we can help you out with. Or alternatively speaking, what if you just pay, like Dustin came on in an episode a week ago, what if you just said, well, it's going to be 1, 2, or 3 years before rates go up to this amount. Why don't I just save money and pile in, pay whatever the amount would have been on a fixed rate mortgage today and stay variable. So again, we want to be really clear in saying that in our world, we advise independently to each person. So we don't want to advise you as the listener per se, but we still personally believe that the variable rate makes a lot of sense and there's more upside than downside at this moment. With that being said, let's jump into a little bit around what could happen going forward, both good and indifferent or bad, and why this could be happening. And just to take the lead on that point, there's a lot of uncertainty right now. The one thing that is certain in Canada is that Omicron and all that kind of stuff, although it had an impact there in December and January, it's certainly bounced back way faster than the government expected. All of the provinces, except for this really odd and slow and confusing province of BC, have eliminated their passports and mandates, thankfully. And so what that means is people are back to business as usual, and that means people are spending more and more and more money in their provinces and enjoying life again, which is fantastic. With that being said, that's another reason why we're seeing the bank increase the lending rate right now, or not the lending rate, the overnight rate, because the country can operate normally, and so people can absorb this slack. People have saved more money than ever in the last 2 years, believe it or not. So for most people to stress or worry about this increase is probably null and void anyways. But for the bank to do this basically suggests that people can afford it. We can afford it essentially at this point right now.
Inflation's a big piece here too. I know, just talking to somebody, they told me their donut was $1.25 at Tim Hortons, and it was 99 cents a couple of weeks ago. I don't know if that's true. I don't eat donuts from Tim Hortons, but it's a good example of where inflation's coming. I mean, I know for a fact that, you know, many things at the grocery store are at least 20 to 40, even 40% more expensive. And inflation plays a big piece of this, and that isn't going to stop. And when a war in Europe starts to, you know, happen, that provides a lot of uncertainty. And that could actually cause even more inflation with the cost. I mean, everyone's looking at the fuel pumps right now. It's through the roof. There's so many things here that could play in. So, you know, there are predictions out there that people actually think that the prime rate could come back down. So, you know, where we stand is there's so much uncertainty here. We've made our predictions in previous episodes, and I think we feel pretty strong about that. But I'd say the one thing I feel very, very strong is this has been the craziest past 2 years of all of our lives, and we could all agree that. And who knows what's going to happen. But the one thing I can stand behind, and you could say what you want about our government, there's a lot of negative things you could say that I would agree with, but they have been very transparent when it came to the rates and what's going on with the rates. They were very transparent that the rates were going to drop, and they continued to drop, and they did that. And they've been very transparent that they were going to come up, and they pretty much followed the exact schedule that they said they would. And I found that in the past in my career, it's been a lot of surprises when the rate changed. There hasn't been a lot of, you know, transparency to when it's going to happen and mentally being able to prepare for it. You know, like we typically in our business, when the rate changes, we're flooded with phone calls. And yes, we got a lot of phone calls and continue to get a lot of phone calls because of this change, but it's nowhere near what it has been in the past, at least for me, because there's been so much awareness that this was coming, and it has allowed people to prepare. So I'd say the one thing the government's done a great job at is just being transparent when it comes to an interest rate perspective.
Yeah, I agree. Those are good points. And I think the last thing on this topic is just, we have to keep in mind, like a lot of people look at this as a negative, like rates have gone up. We've also, like this is a tactic that the government and the Bank of Canada implement when we are in an economic crisis, right? Like they drop rates to stimulate all of us to go and buy stuff and borrow money so that it helps the economy while we're in a rut, right? So this is just saying, like Alex touched on, like things are getting back to normal. People are in the position that they can afford a bit of a higher rate, and this is typical, right? Like we can't expect these rates to stay this low forever. It's not realistic, and we're just getting back to the norm, which on a high level, I mean, it is a good thing.
Yeah, I agree on all the above. So, I mean, looking forward into what could happen here in the next, I don't know, year or two. I mean, we don't know exactly what's going to happen, but based on what you just said, based on what Dean just said, the rates are going to continue to rise. And I think that consumers should be prepared for that, and they should be understanding that, and we always talk to every person that we get a mortgage or prepare a mortgage with, that this could happen. This is one of the things that we do as advisors, is to share that feedback. You know, rates, again, they will go up. What level is difficult to say. The target is 2%. We stand at 0.5% today. The target has been 2% for the better part of, I don't know, 5 years, 7 years, 10 years. I mean, the Bank of Canada went up between 2017 and 2018 with a target of 2% before it dropped with COVID. So the one thing that we can never account for, and this is what I try to remind every single person that has a variable rate mortgage that's concerned about this, we cannot account for COVIDs of the world. We can't account for Ukrainian, Russian wars. We can't account for these things happening, and some of them impact us bigger than others. And for that reason, we don't see rates just going on a gradual status up forever. Things will slow down, something else will happen, there will be a plateau, there'll be some other concern, and then of course the bank will have to use this lever. And this is what they do. They go up and down. They have a goal of where they want to be. And I think as a consumer, if you look at that, if the target is 2%, let's be really specific with that. That would be 1.5% above where we're at today. So if you have a variable rate mortgage and today you're sitting at 1.7, that brings you to 3.2. So go and find out what your fixed rate mortgage is with your bank. And if your fixed rate mortgage is 3.1, 3.2, 3.3, which probably is, and really, are you that bad off? I think you'd be better off to just prepare yourself properly and be aware of the worst case scenario. That's just my feedback.
Yeah, agreed.
So last little quick little note on this point here, because I think we just want to remind all of our listeners of what you can do. When you're doing a restructure, Dean had some good points. If you are set, you want to lock in, then now is the time to take advantage of a refinance. So Dean, maybe walk through a couple scenarios that you've seen recently, and if someone is really going to go and they're going to lock in, what should they consider? What should they do?
Yeah, I mean, as always, we have a lot of people reach out to lock in, and they're adamant that they need to lock in, and it just provides some stability. And what that means, to Derek's point earlier, is your payment's going to go up. To do that, you're likely locking into a higher rate, so you need to prepare for a higher payment. And we always want to analyze, well, what other payments do you have going on in your life, and is this actually doable? And what we found is a lot of times people are carrying a lot more high interest debt than just the mortgage. So car loans, we see average car loans are hovering at 4.99% to as high as 7%. Somebody on our team saw a hot tub loan for 15 years at 8%. Like, just very, very high interest rates, and that come with payments, substantial payments, anywhere from, I would say on average our clients are carrying about another $1,000 to $2,000 in payments across line of credits, credit cards, car loans, hot tub loans, boat loans, you name it. So what should you do if there's equity in your home, which a lot of us have a lot of equity from the recent boom in our market, and you want to lock in at a higher payment? Well, why not look at the whole payments and bring some of those loans into the mortgage, if not all of your debt into the mortgage, and bring down your overall monthly liabilities in a big way. So on average, I would say those $2,000 of unsecured debt payments plus the mortgage payment, we're seeing an overall payment reduction of at least 35% in these situations. And that's huge. So that helps weather the increased payment from the fixed rate by lowering those other payments, and it saves you an absolute boatload, part of the pun, for interest costs.
Let's be specific on some of those things too. Like, you did a good job explaining, the common situation. Remember, if you lock in for whatever 3, 4, 5 years, be prepared that you are not likely to be able to refinance in that term, guys. Like, if you refinance that term, you are going to pay a large penalty. So you got to be really prepared to not be able to access that equity. And that's the number one reason people are breaking, besides selling, obviously, is refinancing, especially with the equity growth in properties. So if you're thinking you want equity out to maybe possibly, at some point in the near future, buy real estate, buy a boat, whatever, anything of that nature, then consider this is the time to restructure, refinance, re-amortize the loan to make the payments manageable, and or add a home equity line of credit through our team. Now, I want to be really clear in this process. You should not just walk into your bank and do this. They will not offer you favorable terms, nor will they actually analyze your file. You should hear the things that we hear when we're talking to clients when they've walked into the branch. The advice, I question it. I'm not going to say anything bad about a bank, but the advice should be very clear, and you should understand what your payment structure is, what kinds of money that you can get out right now, what the impact of the prepayment penalties are, and so much more. A perfect example, Dean just mentioned a car loan at 4.99%. I would say the average car loan payment I see works out to, and remember guys, banks don't look at biweekly, so the average car loan I see is about $600 to $700. Again, from a mortgage payment standpoint, if you wanted to buy a second home or do anything for that matter, that's like $200,000 gone. That's a massive bump to your cash flow. Like if you looked at actually putting that $50,000 loan into your mortgage, that's like a $200 payment, right? So it makes a big difference. Now, I'm not saying add all your car loans into your mortgages, but I am saying think about that and think about the other things that you might want to do just before you actually lock in. Just get a second opinion.
Yeah. Just from a budgeting perspective, I mean, we talk about the fear of rising payments, right? But like, look at what you guys just said. Like, we're talking $700-800 payments for a vehicle, hot tub payments, like motorcycle payments. Let's not worry about our mortgage going up by $100 here and $100 there. Like, our mortgage is actually an asset. It's a phenomenal investment. Let's get rid of the other stuff that are these huge payments, right? Like, if you're really looking at budget and cash flow, like, let's get rid of those. Whether that means selling some of those items or consolidating them. And, you could even bump up your mortgage payment, right? So you're paying your principal down quicker because you don't want to amortize your vehicle debt over 30 years. take advantage of that, right? The rates are lower, it's going to get your payment down, and it does wonders for qualification.
Just take that and run with it. We got to do an episode on that. The problem in Canada is not mortgage rates. The problem is cars, vehicles, boats, and other things. I would 1,000,000% agree. And back to that point right there that Dean made about the hot tub situation. I love my hot tub, so I am not looking down on my client for getting a hot tub, but when we're looking at worrying about a 0.25% rate hike or a 1% rate hike on our mortgage, and we're talking about someone spending $1,000 on a car loan, or a couple $100 on a 15-year mortgage hot tub. Again, not to make our clients feel bad, because nothing wrong with that. It's just that these are the different types of terms. You need to be looking at your money differently and look at more appreciating assets and buy more freaking real estate.
One thing I'll just end on this topic is we said a lot on this episode, and it comes full circle here at this point. If you are locking in and you are considering these options, you don't need to rush this process at all. Like Derek mentioned, fixed rates are at an all-time high for the last 3 years or so right now. They're not going up. So if your goal is to lock in, you don't need to rush and lock in this week by any means. Take your time, have a conversation with a professional mortgage broker like us, and look at these options and just take the urgency out of this. I mean, of course, the only urgency I would put behind this is to get out of those high interest debts and get into this mortgage as quick as possible to start saving interest. But from a perspective of trying to do this because you're afraid the fixed rates are just going to keep going up, just slow down and do this right, because you only have the one opportunity to do this right. Because to Alex's point, you lock in, you quickly sign that fixed rate offer, and this ain't happening for 3 years, right? So just slow down.
All right, guys, I think that's about it. So if you haven't already checked out the resource on our website, we update our variable rate web page every single time that there is a Bank of Canada announcement. We update this web page and we put in what happened, full breakdown. And our YouTube channel has actually been a fantastic resource. At least we've been advised from our clients lately, because we put out weekly videos, weekly content, letting you know what's happening, what's going on. So check out if you haven't already. Go to our website, bookmark that, but go to our YouTube page and make sure to subscribe. Just search us up, Thrive Mortgage Co. Again, that's Thrive Mortgage Co. There is a US Thrive Mortgage. And subscribe to our channel so you're getting all the latest updates. And of course, we know you're loving the podcast, because if you're still here at this point right now, you must be loving it. So go ahead and leave us a great review on iTunes if you can, and check us out on Instagram. Let us know how you're loving it. Really appreciate your feedback, and we'd like to do more mug giveaways. So if you're going to give us that review, send us a message on Instagram. Let us know so we can give away a cool little Thrive mug, and we'll see you on the next one. Thanks, guys.